Do I start?
Yeah, we are about to start. I think we'll be able to start. Okay, so welcome to the another edition of the World Bank Tokyo online seminar series. My name is Koichi Omori. I am Senior External Affairs Officer of the World Bank based in Tokyo. Every year, the World Bank's regional chief economist offices launch the regional economic update, actually twice a year in April and October. And then each time we are featuring these reports to introduce to the audience in Japan whenever the latest edition of such a regional economic update being released. As usual, we are going to start with the East Asia and the Pacific regional economic update for this semester, October 2024. Today, we are going to have the Aegis Islamaj, who is the senior economist in the office of the chief economist for the East Asia and the Pacific region of the World Bank, presenting the main point of the East Asia Pacific Economic Update October 2024 edition, titled Jobs and Technology. This was just released. We will be listening to Aegis presenting the report of the main point of the report for the next 35-40 minutes or so. And then after his presentation, I'll read the questions that we received from the audience on your behalf. If you did not have opportunities to send your questions in advance, please do send your question using the online form posted on the website announcement page of this seminar, or you will be certainly able to put your question posted on the chat section of the YouTube screen. So I'll read your question on your behalf, asking Ergis to make the comment and responses. So with that, I would now like to formally invite Ergis Islamaj, the senior economist in the office of the regional economist, the regional chief economist for the East Asia and Pacific, to talk about the latest edition of the EAP Economic Update. Ergis, please come in. Thank you.
Thank you, Koichi, and thank you, everybody. I'm very happy you have all joined this morning to listen once again to our update. As always, this is the first presentation we're doing outside the official dissemination event, and that's thanks to Koichi, who always gets in touch with us the first, and then we are happy to share it with our Japanese counterparts. So, as always, I'll present a review of recent developments, which is part of what this update is about. And then we'll present the special focus of the report, which this time is on jobs and technology. So let's start. Now, basically, you have the links there. I hope you all download the report and look at the report. There are different resources on the website, including all the data for the pictures. So now let me just try to focus on the main points. So picture this. The EAP region, and again, usually our focus is in developing EAP region, is a vibrant economic powerhouse. It outpaces global growth. This has been the case for a long time, and it's still the case now. So the EAP region is growing more than, say, the advanced economies, of course, and more than other EMDs, other emerging markets and developing economies on average. This is impressive, of course, but there is a slight twist. We are not sprinting anymore. It's as if there is a recalibration of growth. So growth today is slower than it was before the pandemic. Maybe Indonesia is an exception where growth today and in the next couple of years is projected to be similar to what it was before the pandemic, but everywhere else in the region we seem to be kind of going slowly towards lower growth. Now, what does this mean and why does it matter? Well, one implication of this slowing growth, again, this is like us trying to worry about, but it is good news because East Asia is growing. But one implication of this growth, apart from what it does to the welfare of the people, is how fast this region will approach higher incomes and close the gap with more advanced economies. In this chart that you see here, what we are doing, we are comparing over a period of time the growth rate in the region's economies with the growth rate in a few advanced economies, right? So this is the chart is showing the difference in the growth rates. And everything here is at the PPP, so it takes care about, the differences in cost of living across countries. And what you see is that in the period just after the Great Recession, the point here, for example, between 2010 to 2014, China was growing more than 8 percentage points more than, say, advanced economies like EU, UK, and the US. And other East Asian economies were also growing quite fast, which means they were closing that gap that is there between these economies. But over time, say between 2015 and 2019, and again, we're still before COVID, that gap, that speed of growth, or that difference in growth was already slowing down, which means East Asian economies were now catching up a little slower with the advanced economies, but they were still catching up. Now, after the COVID, and we are basically taking out the years 2020 and 2021, which were problematic years for many reasons, and we're looking ahead to the actual growth rates that we have. And it will be the same figure if you project in the next couple of years. We see that, again, that speed of convergence, that difference with higher income economies is getting smaller and smaller. And in countries like Myanmar, Thailand, Mongolia, they're actually falling further behind. And that is unfortunate. And also the same problem exists for many countries in the Pacific, many of whom, even now, I'm not showing this chart here, but we show it in the update, and I showed it in earlier presentations. Some of the Pacific economies, they have still not returned to the levels of output that they had before the pandemic. So we try to ask, why is this happening? So while we see good growth in East Asia, we are a little worried, not too worried, but a little worried about these trends, and we want to know what's happening. So basically, we need to understand what is under the hood of this growth that we see in the headline numbers of East Asia. Now, one reason is that household spending, and this chart here shows the growth in retail sales. It's kind of a little bit different from the charts we've shown in previous times, because what we've done here is is more like a long-term trend. So we compare at each point in time, we compare the retail sales, for example, the consumer spending at the point in time with what it was 5 years ago, and take the average over the 5 years to annualize it, basically. So what this shows is that over time, over a period of a decade that we show here, this consumer spending growth has slowed down. And at the same time, so has investment growth. So the productive capacity, investment enhances the productive capacity of the economies, and we see also a slowing growth in investment. There are exceptions. For example, consumer spending in Malaysia up here is relatively strong today, but investment is not. Whereas in Vietnam, investment seems to be seeing a revival. So this is one of the things that we document in the update, basically saying that this growth has been good, so far this year, but looking ahead, the sentiments for consumers, especially across the region, are low. And in some countries, also private investment is low. So when it comes to exports, the region is seeing a gradual recovery in exports. Now, exports are an important part of growth in the region because this region has thrived through exporting, right? And the exports had slumped last year, and even last time that we presented this update, we were still worried about how fast exports are going to start growing. Now they are beginning to recover. But notice that this recovery is only gradual, right? So we are seeing a recovery in exports, and we have documented that, but we're not. I mean, it's not like this export growth that we saw, when the pandemic, right after the pandemic, for example, or right after a few months of the pandemic, where everybody was buying goods from East Asia, or like it was, in the last 2 decades. So another interesting phenomenon that we see in the region is this shift in the patterns of exports. For example, China's share of exports to rich countries has declined, right? But its exports to other ASEAN economies and to the rest of the world. So this rest of the world is mostly developing economies and some other advanced economies. I mean, so Japan would be in this light blue area here. I mean, here you still have some other economies that are not are classified as high income, but are not part of US, EU, and advanced EAP. But mostly is developing economies. For example, we don't really use the BRICS, but if you think about the BRICS countries, so Brazil, India, Russia, South Africa, they're basically in here, and there you can see that China is also exporting more to those countries. So, but point that I want to make for this chart, I was just reacting to one of the online questions, is that this purple area, that we see a trend towards deeper integration within the region. So that is good news. Again, it's not like something that will make us over enthusiastic about the growth prospects of the region, but it is supporting growth. Then the last pillar, again, if you realize here, what we're doing is C plus I plus G plus net exports, right? So I showed C plus I plus net exports, and now we're showing what will happen to basically government policy. This is not exactly G because it's not a policy, but is the macroeconomic policy that supports growth. So we also talk about fiscal policy in the report. Here I'm only going to focus on monetary policy. And monetary policy has been in the region, can be summarized as basically doing this balancing act. So there was inflation, countries in the region increased their interest rates, still lower than the rest of the world, but tighter monetary policy. And now inflation has come down, but what we've seen in the last year, at least, they've been more cautious about lowering interest rates because US interest rates were also high, and they were basically trying to discourage capital outflows from the region, which would put pressure on exchange rates. But now, as US interest rates are coming down, this has given a little more space to the region's economies, and some of them are lowering interest rates. For example, Indonesia, Vietnam, we saw recently, and I think at some point we saw Philippines too. Now, so again, all this is in the context of a low inflation in the region, with the exception of Laos, PTR, and Myanmar, that they are basically struggling with their macroeconomic imbalances. But normally, inflation in the region has been subsided. Now, looking forward, we identify a triple threat. Now, what we worry about, what these three risks that I mentioned are these. First and foremost is the geopolitical risk. Now, there have been really distressing events, maybe all around the world, but especially in the Middle East, and they've had, deep consequences on human life in the areas affected, but they also have and can have economic consequences for their regions and for the rest of the world. For example, due to these conflicts in the Middle East, transport has been disrupted. Ships that transport goods, would export goods from East Asia to the rest of the world, instead of going through the most efficient route, which was through the Suez Canal, now take a long winding route around the Cape of Good Hope. Now, it's great because that has made sure that we haven't seen disruptions in the value chains and in the shipping of these goods, but that has increased shipping costs in an estimate that we mentioned in our update by something like 40% if you look at one of these indices of shipping. Now, the concern, but again, so far that hasn't been transmitted to inflation in the region, and we haven't, as I said, we haven't seen disruptions. But the concern is that an escalation in the conflict could increase prices of other essentials, like for example, oil, or also, if there is more disruptions in shipping, can disrupt global demand for the region's exports. So this is one risk that we are worried about, and it's we present as a risk in our update. The second is China growth. Now, China has been a powerful engine of growth globally, and that has spilled over to the rest of the world, and especially to other countries in the region, especially developing AP that we focus on. But what is happening is that growth in China is slowing down, right? And we basically spend quite some space or allocate quite some space to China in our report, discussing what is happening inside China and why there are both short-term problems, and now they're dealing with low consumer confidence, but even in the longer term, they're dealing with like a structural slowdown. So however you take it, we're not saying that China is crashing, but growth in China will progressively be slower than what we saw in the previous decades, which at some point it was double digits. So this growth in China means fewer spillovers to the region's economies, and the region must contend with that. The good news, at least in the short term, is that the United States seems to be each and every day seem to be approaching to a soft landing, which basically means the economic conditions in the US and also spill over to the AP region, we have shown this in the past, are good. And at the same time, because these interest rates are coming down, the financial conditions are also more benign globally. Now, finally, and this is also a worry, and we spend, like other times, quite some time in this report to this part, we worry about policy, and especially about trade policy. So across the world, we've seen a sequence, so this is the final chart, we've seen a sequence of measures that have been restricting trade. Some of them are explicit tariffs, some of them are export restrictions, and some are these new industrial policies that are often accompanied by, say, local content requirement, which make producers choose domestic inputs over foreign inputs in order to qualify for subsidies, for example, in the US. Now, I'm not showing here, but if you show a similar chart for the region, it looks, beside the number of measures, because this is the global, the chart looks pretty similar. So the region too has seen an increase in these restrictive measures, and that is a concern for us, because especially this region has thrived through openings in trade and investment. I mean, both for the home markets and also basically benefiting from the markets abroad. So to address these risks and growth that is there, but under the hood we see a little bit of sputtering in certain components of growth, we suggest a two-pronged response to these difficulties. So first, given now that we are seeing less open markets for goods and slowing growth in China, and add to that, increasing geopolitical tensions, the region should turn to structural domestic reforms. We have shown in past updates that the pace of reforms had kind of slowed down in the past because they were benefiting from these external factors, but they need to make sure that they don't give up on domestic reforms. And here, one example, for example, is that the region, although it's very open to trade, it still protects its services sectors, right? And this is kind of almost paradoxical, right? Because it's the region that has benefiting enormously from openness to trade. So we argue that opening up telecom, transport, finance, professional services, especially now that we're seeing all these new technologies come into place, it could bring significant productivity benefits. If they keep them restricted, then the productivity benefits will also be smaller. And this applies not just to the services, but also, say, manufacturing or agriculture, which would rely on these services, and they can all benefit and increase the productivity of the overall economy. The second pillar, so in parallel with domestic reforms, we argue for the need for deeper trade agreements. For example, RCEP was an important step in that direction, but these deep trade agreements can help insulate countries from some of the consequences of protectionist trade and industrial policies that the large countries, large trading partners are undertaking. For instance, now this is outside the region, but take Mexico. So Mexico has suffered less from certain provisions of the Inflation Reduction Act in the US or the CHIPS Act, because Mexico has been part of the older NAFTA, US-Mexico-Canada agreement, and because of that has been exempt of many of the restrictions that the IRA and CHIPS Act have put in place. So this was a really short summary of the first part of our report. I'm happy to take more questions later about this part, or I invite you to go and check the report, where again it's quite long actually, and you can get more details. And again, all the charts and all these things, if you need to replicate them for any of your presentations, they are available online, and it's very easy to use them, and they're open. Now, we go basically, if trade was one pillar of the region's remarkable development, the other pillar, we argue, was the ability to produce what they exported with labor-intensive technologies, right? They were employing a lot of people to work in manufacturing, which was producing these goods, not just for the region, but for all the rest of the world. And what happened is that, that labor-intensive production was employing lots of people in the region and was also lifting millions of people out of poverty. So basically, employment and the way, the reliance of the region in labor-intensive production makes this question that we're asking about how technology is affecting the labor markets. I mean, not just intellectual curiosity, because technology is new, and of course we want to know how it affects employment, but it's especially pertinent for the region. So basically, we said, how are these new technologies affecting the relationship between growth and jobs, and especially how they are affecting employment? Now, again, the data is not great, but we try to basically at least bring it all together and present to you how we think about it and what are some of the early findings. Maybe as more data comes in, we're going to learn more about these things, but some of these findings with the evidence we have at hand right now, I'm going to try to present them to you and hopefully convince you that this is indeed a very pertinent issue. Now, there is important work that other people have done, but usually, especially when you go to try to find these academic papers, you see that people are focusing on one technology, so that because they want to have a clear identification. Say, for example, they look at industrial robots or other technologies. And they tell you about that, but then another piece of work tells you about another application of this technology and how that affected employment here and there. So what we try to do, and maybe imperfectly, is to take an integrated view of these issues. And let me try to walk you how we think about it, and then the details. Some of them, as I said, are in the report. Some of them they'll come in in a follow-up report in the future, because right now we don't have all the information. But let's think like a two-dimensional space, like what we see here, and try to basically imagine how are we going to explain, these jobs and this the coming of these new technologies in this space. So imagine now that in this two-dimensional space it's going to be populated by different types of jobs. And what we have done, and again here we followed other people, that this is our creation, but inspired by other people, is in the lower part of the horizontal line we will put jobs that primarily involve tasks performed by hand, right? So these are usually jobs that requires workers to work there in the factory. Always, some of them are more skilled than the others, but they will be performed by hand. In the upper part of this horizontal line, it's more like they're called cognitive jobs, but these jobs involve, say, the mind, right? We can think like that. Now, on the left, we will put jobs that are mostly mechanical around here, and on the right, we'll put jobs that are again non-routine. They are more mind-based. Now, for example, just to illustrate what I'm saying, but this is like our illustration of this. You can again have many jobs and try to fit them in this space. Think that here on the lower left quadrant, right? You have mostly mechanical routine jobs, and this includes assembly line workers, for example, in Vietnam, who are putting together the iPhone. So when they do one iPhone after the other, put the components together, that's quite routine, right? Or in Thailand, assembling cars. This is, again, a thing that can be done over and over in an assembly line. It doesn't require lots of skill, but it's a physical work. Then you think up here is, these are mind-based occupations. We pick bank tellers. Maybe it's not the best example, but it will make the point. They, of course, they need to count. They need to read and write. Maybe some places they require some more schooling than the other professions that were down here. But it's the job itself is relatively routine, right? Put the money there, count, finalize the spreadsheets at the end of the day, and report it. Everything is good. They don't have a lot of creativity in those types of work. So again, I don't want to pick on bank tellers, but this was just an example we thought about. Now, think, for example, here in this upper right quadrant, somebody like a financial analyst, but you can think of maybe like a manager or lawyer, right? So these are jobs of the mind. So they require more strategy, more creativity. They need to maybe draw together data from different sources and come up with a conclusion or make their own judgment and then apply the judgment to spur into action, right? And finally, there are other jobs which combine this. So there are physical jobs, but they require like mental alertness, cognitive awareness, and even driving falls here if you think about it, right? Now, if we think, the jobs in this space, it's now easier for us to think how each technology will affect each jobs, right? And some of this has already happened or is happening right now. First came the robots, right? And maybe together with the computers, right? The robots now are performing tasks that were routine manual tasks. So over here, so it's easy for the robots to replace some of those jobs. At the same time, computers and ATMs up here, they are performing tasks which were cognitive but routine, right? So there was not a lot of creative thinkings there. Now, what we are seeing nowadays, and the big boost that is really, pushing the limits of these changes is artificial intelligence. So first, this artificial intelligence, I mean, again, it's not just financial analysts, it's a large number of tasks. They require more sophisticated thinking, more sophisticated cognitive skills, but they can be performed by artificial intelligence. So there are some professions here as well, which, can be replaced in at least in theory. And lurking in the background, maybe it's still early, but maybe it's coming fast in the next couple of years. It's a combination of robots and artificial intelligence. Like, for example, think that, self-driving cars. So they cannot just do the mechanical work of moving the car along, but also, they would replace for the self-awareness that the driver needs to have and be able to navigate efficiently through cities. Now, of course, this is not to say that this is all negative. There will remain jobs, and here we pick teachers, and again, you can come up with other examples, that some tasks, they can still use artificial intelligence, and this will maybe increase their productivity, maybe even make them happier. Like, for example, they can, instead of writing exams and grading exams, the exams now can be put online, and they can be graded online, and they can use the time more efficiently. And for example, they could basically try to spend more one-on-one time with the students, be more empathetic with the students, or a doctor, rather than going rummaging through the books to figure out what disease matches with the certain symptoms that the patient has. They may now use artificial intelligence to get a better idea and come faster to a conclusion. And ideally, the way they're going to save those jobs is by spending more time with the patient, understanding more, showing more empathy and kindness and sensitivity, and this will basically make them irreplaceable. Now, again, this is just a little bit conceptual at this point, but when you look at the picture, one question that arises is, what about the region? Like, where are the jobs? In which space? In which corner of this space are the jobs in the region? So what we try to do in the report is to try to map that as well. And what we see here, again, populated like everywhere, because we see the region being quite developed in many ways. But on average, the region has most jobs still involving manual work. So these are in the lower half of this horizontal line, and basically it's around 60% of the jobs require manual work. Now, at the same time, look at this 13% here. It has fewer jobs involving cognitive skills or cognitive tasks. Now, the reason why it is like this is not a surprise, because this reflects a successful industrialization of the many countries in the region, which has had very positive effects of creating manufacturing jobs. And also services would fall here. The services in the region are quite protected. Now, if you compare the region with advanced countries and other emerging markets, what stands out is that is the fact that the region has relatively more routine manual jobs. Again, not way out there, but it has more routine manual jobs. So compared to, say, advanced economies, the region should be a little more worried about industrial robots. Now, it is also true that the region has fewer jobs in this occupation that involve non-routine cognitive tasks. So the good news is that compared to, say, advanced economies, the region, and this is true for other emerging markets as well, they are not so susceptible, that's not so at risk from artificial intelligence. But the bad news is also that they will not benefit as much from the productivity enhancements and empowerments that artificial intelligence may offer. So if you look across the countries in the region, you broadly see the same pattern. Again, here and there are exceptions. For example, Malaysia stands out as having a relatively high share of this non-routine cognitive jobs that compared to other countries, I think this is listing here 24%, and basically the routine manual jobs 16% is smaller than in the rest of the region, which is probably Malaysia should watch out, but also better place to take advantage of the productivity opportunities that these technologies bring. Now, let's basically discuss a little bit some more details of the report. So first, the question of industrial robots. So here you see a large increase in the penetration. First, it was in Thailand and Malaysia, and then in the last few years, we've seen also in China and in Vietnam. But again, I mean, it's really good. It's growing really fast. It still has to catch up with advanced economies, but it's getting there. And the good news is that, it's not that these robots are only coming in say, automotive sectors or computer and electronics, but they're coming in almost all sectors like rubber and plastic and industrial machinery and so on. Again, the 4 countries that I mentioned, Vietnam, Thailand, Malaysia, China, are up here, but also notice that there is quite some gap between these countries that are ahead in terms of technology in the region and the other countries such as Indonesia or the Philippines, right? That are not, and basically they are not being touched as much. They haven't seen as much penetration of robots. Now, when you think about these robots, you ask, okay, what effect is going to have on jobs? What do we expect is going to happen? Now, of course, if a robot performs a task exactly or better than a human being, it can displace jobs. No, but before we go and say, oh, this is the story, we're done. Let's try to be not to be this pessimistic. Right? Let's start to think, why do we want, or why a firm would adopt a robot? Right? They're going to adopt a robot because it boosts productivity. It will increase the scale of production and lower prices. And if it lowers prices, it will attract more consumers, and that will increase the scale of production. Right? So even if for each unit of a car, you now need fewer workers, you're going to be selling more cars, so you may end up increasing employment. So we asked what has been happening, right? So a simple chart that basically looks at by sector the again penetration of robots, the usage of robots on the horizontal axis, and the average change in employment in the last decade, or from 2010 to 2020, we see that this is roughly a positive relationship. Basically means that robots in these industries, computers, automotive, and etc., mostly in industry, have increased employment, not lowered employment, right? Now, that is the good news. Overall news is good, but there is some nuances to this. I mean, not everything is great. First, robots have helped. What we find is that they have helped the relatively high-skilled workers, and some back-of-the-envelope calculations that we do, they have created as many as 2 million jobs. But at the same time, they have displaced some low-skilled workers, right? And again, this was to be expected, but on net, they have created more jobs. One thing that we noticed and we need to think about is that these low-skilled workers that were displaced by the robots, they moved to the informal sectors. So now we have, like, again, a new form of informality, that we have more people moving into the informal sector. So going to artificial intelligence, this is the new kid on the block. Here the evidence is less scarce, but some, and again, go to the report, we try to bring in some empirical evidence, is that what we see is that in occupations that are more exposed to artificial intelligence, we see lower earnings. So basically, they're already feeling a little threatened, but no impact, at least yet, on employment. Just to get a sense, we also looked at which occupations and which demographics were more exposed. So higher educated, of course, are more exposed to artificial intelligence. Lower educated, low skills are more exposed to robots. And female women employing occupations were more likely to be exposed to artificial intelligence as well. Again, this is preliminary, but something to watch out. Now, I rushed a little bit in the last two slides because we are running out of time and I want to leave time for questions, but let me conclude by discussing a little bit policy recommendations. What can be done? So how can we embrace this future of new technologies? So the report provides, you're going to see 4 policy recommendations. And the most important, we believe, is the need to strengthen skills. And this includes digital skills, so people can engage with these technologies, social and emotional skills. Again, I mentioned earlier the empathy and sensitivity. This is something that human beings have a comparative advantage in, even in the future where robots will really be doing more tasks than today. We hope we do have a comparative advantage in social and emotional skills. And at the same time, advanced technical skills, which are needed to create these technologies, service these technologies. And here, a problem that we mentioned in the report is that the region has relatively few STEM graduates. So, we should focus on STEM, but also not just do math and engineering, but let's also combine that with social and emotional skills. So equipping people with skills is first priority. The second must be to basically make sure that there's no impediments to capital and labor mobility. So people and as well as firms or people and capital can move to where the opportunities are. And we've talked in the past in other contexts where the bankruptcy laws are weak. It can trap resources in efficient firms, or where there are restrictions in labor mobility, like China and Vietnam, and there can be restrictions or low mobility across states, occupations, sectors, etc. But we don't want that because we don't want people to get trapped in lower productivity situations. Now, the third policy recommendation that we recommend is to remove factor price distortions. So what do we mean by that? This is basically, there's a lot of work done in the US, and Ajemoglu was awarded the Nobel Prize in Economics, I think just this week. Basically has been talking a lot about this, that the way incentives have worked in the US is that they have favored capital and not labor, but we want to ensure that technology adoption in the region happens on the basis of the price of labor and the real price of capital. Right? We don't want technology, basically the policies, to favor capital versus labor. So we don't want just to say, oh, let's try to develop it, let's try to subsidize labor saving technologies, but let's subsidize or let's help provide incentives for technologies that increase productivity and make everybody better off. And finally, now I mentioned this informality, right? From low-skilled workers that were in manufacturing before, and now they're moving to informal sectors because they're being displaced by robots. But at the same time, it's not just them. It's also this maybe high-skilled gig economy workers who like to be in the informal sector. Now, countries need to think of ways to expand social protection for these informal workers so they can also benefit and thrive as these new technologies come. Now, a lot of times the good news is that this is maybe social protection has, especially in the region, sometimes has a bad connotation. So it's not that, okay, these guys cannot make it and we're trying to help them. These are people that maybe are above the poverty line in terms of they're doing work, they're productive, but they may even be able to afford social insurance, so they don't really need the state to pull them along, but they do need or they could use some institutional support or having the environment where they can purchase protection, purchase insurance, and then continue to work productively without having to worry. So I think I'm maybe right on time or just a couple minutes over time. But thanks again for your attention. Do not forget to download the report or go to the website and check out the resources. So I'm happy to entertain any questions.
Thank you very much, Ergis, for sharing the main point of the report, Jobs and Technology, which was just released as the latest edition of the East Asia and Pacific Economic Update. Thank you very much. So let me read some questions that we received in advance, and also some questions actually came during the presentation. So let me start with this one. A question from Sasaki-san. Thank you very much for sharing question, usual. On the page 6, would you please elaborate on the content and composition of the rest of the world category in China's export by destination? This part has been expanding over years. Who are the growing destination countries or regions? I think you mentioned a little bit, but it would be great if you can elaborate a bit more. Thank you.
Yeah, absolutely. Thanks for the question. So an earlier version of that chart had few more categories added in there, but for the sake of presentation, we simplify it a bit. But as I said, so we try to we think of it this way, right? So there is direct trade to US, EU. There's some high income countries, there's say Japan, Korea, Australia that are included there. But there's also, like for example, the administrative region of Hong Kong, it's part of China, right? Which is used as a hub to trade mostly to other advanced economies. So these are lumped together, and in all these categories, we see a decline in the trades, in the export share of China. We do see an increase in other ASEAN economies, so in the developing region mostly. We see an increase in other major emerging markets. This includes Russia as well. And of course, the rest of the countries. Now there are some countries around the world that are classified as high income, but are not part of the big blocs like EU, US, and other countries in the region, and we didn't go in that much detail. But generally, that the rest of the world, in our view and in our feel of the data, represents developing economies, other developing economies.
Thank you for your responses. Let me read the question that we received from Professor Yoshino during your presentation, since this is more or less related to the first part of the report. Question is this: geopolitical risks have to be paid attention to in the Asia-Pacific region. If the tariff policy is introduced, it will discourage free trade, hurting many Asian countries. What would be the best policy to tackle trade dispute among Asia, United States, and Europe? It's a very big question, but if you have any comment, please. Thank you.
It is a very good question. Let me thank Professor Yoshino. He always has very good questions. So let me talk a bit about what is in the report, right? And then maybe some other things that are not in the report, we can all keep thinking together for the next report. First, we allocate quite some space to general uncertainty. And this uncertainty can come from geopolitical tensions. It can come from macroeconomic policies, both in the US and in the region. It can come from policy uncertainties, if there is elections or there's new governments, and especially it can come from trade policy. Right? And this is what we presented there, that this not knowing what's going to happen in November, whether going to end up with much higher tariffs or lower tariffs is a problem. Not knowing how far are they going to go we don't know. Now, what we do in the report, we try to analyze basically what has been happening to trade, how the other countries in the region have seen shifts in the flow of trade and investment, for indirect investment, after the start of the trade war, of the tensions between US and China. And again, this is something we have also said in other updates, but in general, countries in the region other countries in the region have benefited, right? And also around the world, there's been other pockets of the world who have benefited from these rising tensions. Now, some of these countries can be thought of as hubs, is a word that we have used before, and the word that we use now, and the IMF has also been using, as connectors. Like the best examples are Vietnam and Mexico, where they have seen basically foreign direct investment increase from China, trade to the US increase, and basically also foreign direct investment from the US increase. Now, what we have seen though, and what we show in the update, I did not mention it here, is there is an asymmetry, right? So countries that have gotten that have seen an increase in foreign direct investment from China have increased their trade share to the US, their export share to the US. But countries that have benefited from increased investment from the US have not increased or even decreased their share of exports in China market, right? So there is a little bit of what we call one-way connectors. Now, maybe it's just a fluke of the data. Maybe it's because, and we've seen this from many commentators, that nobody is panicking about the trade system collapsing, because what we've seen so far is China and East Asia still trying to get to export goods. They want to export goods, and they're not turning inward yet, but they're just trying to find other way to export goods to the US. And so far that has been working. But, and I mentioned this only in passing in my presentation, but a big risk is that if, say, US or other major trading partners, they start being more picky about, what they accept, what exports they accept. So right now, for example, they're saying, oh, we don't like, we are restricting putting tariffs on goods from China. Then they are on certain goods, they're restricting exports. Then they might go further down and basically talk about rules of origin. So we want, goods that are being sold in our domestic markets to have certain local content. Or they can say, oh, and again, this is just hypothetical. We don't want, it's fine if goods come from Mexico to the US, but the inputs should not have originated from China, or the ownership of the firm that are sending goods from Mexico to the US should not be Chinese. So we call these are summarized as rules of origin. That was the term that I used, right? So if this keeps happening in the future, so far we see some signs of these countries in the region, these countries that have benefited from the trade war, being only one-way connector, not two-way connectors, and that role can diminish even further in the future if the larger trading partners go for more stringent rules of origin. So we're basically trying to use this and say, don't count on that. Don't say that this is going to be our new strategy, just to be the connectors between the two countries, but focus on domestic reforms.
Thank you. Thank you very much. We have 5-6 minutes. Let me read two questions quickly. One on a broader economic question. The other one is more technologies, AI-related technologies-related question. First one, the question that we just received from Ben. Thank you very much for posting your question. How will monetary policy easing by central banks in the United States and the region, such as in the Philippines, impact on the growth prospect moving forward? So that's the first question. Second questions from the Professor Yoshino. Let me read. Brain drain and the lack of high-level university is facing problems of the Asia-Pacific regions. What will be the best solution? And actually, he continues saying that technological progress requires the reskilling of workers to use robots at businesses and the factories. SMEs are lacking the reskilling of employees in the Asia-Pacific region. SMEs do not have money, and SMEs cannot develop their own technologies. Should the government give subsidies for human capital development of SMEs? So those are the questions that we received so far. I'd like to invite Aegis to make responses. Thank you.
Yeah, thank you for the questions. Again, they are very important questions and very deep, so I'll probably only provide a partial answer. But for the monetary policy, so far it has been positive, right? It has been positive. It has not been overall a smooth ride, but it seems like it is creating more space for the region's economies. It is creating more space for them to lower their own interest rates. There's I guess some evidence that, as the rates in the US and bond yields in the US decline, the basically risk-hungry investors, so the appetite for emerging market risk is increasing, and the region is benefiting from that. And this comes on top of a benign US economy, right? As I said, we've seen a soft landing. Now, it seemed not obvious back in August, right? US did not lower the interest rates. Job reports didn't come as good. There was a time when actually the market started first crashing in Japan, and then there was a period that lasted only 1 day or 2 days, where the VIX went through the roof, and everybody was worried. So this is the macroeconomic uncertainty that we talk about in the report. Another thing that could happen, but it didn't seem to have happened so far, and again, we don't have all the information, is that, hey, US finally decided to lower interest rates. It could have gone 25 basis points, but it went 50 basis points. The big question is, what does that signal for the US economy? Right? Some more pessimistic commentators were thinking, hey, low rates is good, but lower rates because US economy is not doing so well. And if the US economy is doing so well, so the region will benefit from financial flows. So it will be a positive to the region. But if the real economy is doing worse, the real flows will basically disadvantage the region. So on net, it's not clear what's going to happen. So these are all scenarios that can happen. So far, the decline in interest rates in advanced economies seems to be helping the region. Not just what helps them is that they have been able to contain inflation, at least most major economies, with the exception of Myanmar and DR. And because of that, lower interest rates in the US and in Europe is basically lowering the pressure of capital outflows and decreasing the pressure on their currencies. So it's good news. The other question about the brain drain, I lost it for a second now, but sorry, can you summarize the question?
Yeah, the brain drain, the lack of the high-level university in the region, whether the government should provide the subsidies to SMEs to enhance the technologies. Thanks.
Yeah, no, that's a very good thing. No, so we should really think seriously about how to develop. So when we think of AI, basically what the government should focus on and what the region should focus on AI augmenting skills. Right? How to do that? Subsidies for certain things may be a way, and Yoshino is right, not everybody can afford that. But we've also talked a lot about liberalization of services. Right? How can we lower the costs in services so they benefit from these global markets? They get more integrated in services, because in the end, education is also a service, right? And we don't try to replicate the same thing in every country, and everywhere there is a fixed cost. This is most obvious in the Pacific Islands, right? Fascinating places, but so isolated, so far apart. Maybe it's too costly or it's hard to maintain like higher education in each of them. But if you think of a regional hub for education that allows basically all the students from different places to come there and get those skills, that might be a solution at lower costs. Again, it would be a combination of solutions. We shouldn't exclude anything, but that definitely remains a priority. But thank you again for the question.
Thank you very much, Ergis. We had a pleasure of having Ergis Islamaj, the senior economist in the Office of the Chief Economist for East Asia and the Pacific region, presenting the latest edition of the East Asia and the Pacific Economic Update, October 2024 edition, titled Jobs and Technology. We'll certainly get back to you, Ergis, again for the next edition in 6 months' time. Hopefully, in a face-to-face manner at some point in the future, but definitely in a virtual manner for sure. So thank you very much. See you next time. Great. Thank you very much. So we'll continue organizing these online seminars. So please stay tuned. We'll continue introducing the respective regional economic update for the next few weeks. Then latest announcement will be posted on our website shortly. Thank you very much. See you next time.